In this video, I will be explaining the accounting equation. Before starting, please subscribe to my channel for more breakdowns on accounting topics. If this video was helpful, please leave a like and comment with any topic suggestions or questions that you need help with. Firstly, we will define what is the accounting equation. There are three key elements which include assets, liabilities, and capital or equity. The equation's standard format is assets minus liabilities equals capital. Using standard math, we can isolate assets by adding liabilities to both sides of the equals function, which gives us assets equals capital plus liabilities. The final stated form is the same as the first format but simplified as assets minus liabilities equals net assets. Secondly, we will define the elements mentioned within the accounting equation. Assets are tangible or intangible items owned by a business to generate value. There are two categories: non-current assets, which are expected to be used for more than one financial period, i.e. for long-term use, such as premises or vehicles. The second category are current assets, which are expected to be used within the financial period, i.e. for short-term use, such as cash in the bank and inventories, which are continuously changing within a business. Liabilities refer to items owed by the business. These can also be distinguished in two separate categories for non-current liabilities, for example, long-term bank loans, or current liabilities such as trade payables, which is the money owed to suppliers. Capital refers to the investment of the business owners, which is placed in the business to allow it to function continuously. Therefore, we can interpret that capital is owed to the business owners. After defining the accounting equation and its elements, it is important to know where it is applied. The elements mentioned of assets, liabilities, and equity are all included in the Statement of Financial Position, which is a key financial statement produced by businesses to interpret their company's value each year for investors and other stakeholders. The accounting equation always balances. Therefore, as the Statement of Financial Position includes all elements mentioned in the equation, the Statement of Financial Position must therefore always balance. We will see this in practice shortly. You might be curious to know why capital changes. Well, business owners might wish to invest more when they are looking to expand business operations because profits might be increasing rapidly and there is pressure to compete with rival businesses in the market who may have larger scale business operations. Capital also includes profits generated in the year, which are then put back in the business to allow it to operate in future periods. If there are any trading losses, this will reduce the overall capital. Similarly, if owners decide to take out some of their investment, which is known as drawings, then this will also reduce overall capital. Here is a simple statement of financial position format illustrated to show the accounting equation in practice. Now we can see the total assets are taken from the total non-current assets and the total current assets added together, giving £185,000. The total liabilities are taken from the total current liabilities and total non-current liabilities, giving £35,000. In applying the accounting equation of assets minus liabilities equals capital, we could therefore interpret that capital is £185,000 minus £35,000, which equals £150,000. We can also interpret the equation by isolating the asset, which should equal to capital plus liabilities, which in this case both the total assets and the total of capital and liabilities give £185,000 and therefore balancing. As previously indicated, the Statement of Financial Position must always balance. If it doesn't, this means an input error has been made somewhere and the figures need to be rechecked. Okay, well, I hope you found this video useful. Please like, comment, and subscribe for more content. Thank you for watching.